Okay, today I'd like to talk to you guys about choosing the right strike price while options trading. It's a basic level of options trading, but something that will help you stay profitable or not be profitable. So how do you stay pick the right price, the right strike price? Yeah, I'm going to share your screen here. I'm getting this information from Investopedia. I believe they're all information, everything you can find, any information you're looking for on any topic online. And with Investopedia, it's like not to promote them or anything, but there's a lot of information here. So just to get out the strike price, what do we mean by the strike price? Let's get that out of the way. It is the price at which a call option or a put option can be exercised. When you pick the strike price, there are two things that you need to bear in mind. The strike price clearly has a huge implication on how your trade's going to play out, whether you're going to be profitable or you're going to end up with a loss. The two things that you want to keep in mind is you want to first know what your risk tolerance is. We already know that a strike price is the price at which a put or call option can be exercised. If you're a conservative investor, you might opt for a call option or strike price that is at the money or below it's at the strike price or below the strike price. If you have a high tolerance, you might prefer for a strike price that's above the strike price. And the inverse is the case with put option strike prices. It's either at that price or above the stock price. Now, if you pick the wrong strike price, you may result in huge amount of losses. And this risk increases when the strike price is set further out the money. While we talk about calculating the strike prices, I mentioned risk tolerance. The other thing that you want to keep in mind is your risk to reward payoff. Your risk tolerance should determine whether you choose an in-the-money call option, an at-the-money call, or an out-of-the-money call. If you're going to go with an in-the-money option, that means that you have to pay attention to the delta of the underlying stock. If the stock price increases by any given amount, the in-the-money call will gain more than an at-the-money or out-of-the-money call. But if the stock price declines, the higher delta of the in-the-money option also means it will decrease more than an at-the-money or out-of-the-money call if the price of the underlying stock price falls. Your risk to reward payoff will basically, in summary, is the amount of capital that you're willing to put up or lose when making the trade. Usually in the money is a lot more expensive, but it's a conservative move. But out of the money is a lot cheaper. You have a higher chance of making more money at the end of it. But but you also have a much larger gain in percentage terms than an in-the-money call if the stock surges past the strike price. But it has a significantly smaller chance of success than an in-the-money call. That means although you're going to have to put down a smaller amount of capital to buy an out-of-the-money call, the odds are you might lose the full amount of your investment or higher than what you would put up with an in-the-money call. So keeping that in mind, a relatively conservative trader might opt for an in-the-money or an at-the-money call. On the other hand, if you have a higher risk tolerance, you would prefer to go with an out-of-the-money call. So we're going to look at a specific example here. I'm going to switch out here and show you my chart for an Amazon call. But before that, let's use the example that we have here. This is a strike price selection for a GE. ticker from March of 2014. There are two traders here, Carla and Ricky. Carla's conservative, Ricky likes to spend. Carla, on the other hand, so this chart here identifies the different strike prices on the month of March of 2017. At the time, the last price for the stock, the GE stock, was $27.20. And the strike prices ranged from $24 to $30. The premium, or how much you have to pay for the call options, are listed here, and their implied volume. With GE trading at $27.20, Carla decided that she was bullish. Well, both of them were bullish on this particular stock, and Carla expected it to go up to $28. And in terms of her downside risk, she thinks that the stock could decline to $26. So she chose to be conservative and purchased the $25 call, and she put up $2.26 for that call, which will cost her $226 total, considering that one call is 100 shares. That $2.26 is referred to as the premium of the call. So if you were to split that into intrinsic value and time value, the intrinsic value is $2.20, meaning the stock price of $27.20, subtracting the strike price of $25, and the time value is 6 cents. That time value is calculated as the call price of $2.26, subtracting the intrinsic value of $2.20. Rick, being a little bit more risk averse, he's also bullish, but in this case, he's looking for a better percentage payoff, even if it means him losing his entire capital. Now, keep in mind, so he decides to go for an out of the money call. An out of the money call is a lot cheaper, so he paid 38 cents for a $28 call. Since this is an out of the money call, it only has time value and no intrinsic value. The price of Carla's and Rick's calls over a range of different prices for GE shares, they expire, and they're all March expiration dates, as I pointed out. So this chart basically kind of lists out, or not a chart, this table lists out what their profit or their payoff look like. You can see that by the time the stock price expires at $28, Carla is profitable at $32.7%. Rick does not get profitable until the strike price hits $29, where he's now 163.2% profitable. So you can see that at $28, Carla had 32.7% profit, and at $29, Rick had 163.2%. Rick had a higher payoff, but he also, if the stock price dropped down to $26, he would have lost 100% of his investment. If the stock price dropped to $27, he would have also lost 100. He didn't get profitable until the stock price moved to $29, and this, keep in mind, should include the commissions, brokerage commissions and fees, as well as the initial capital investment. Each option contract generally represents 100 shares, like I said. 38 cents would involve money upfront of $38 for one contract. An option price of $2.26 requires an expense of $226. So in Carla's case, GE should trade at least $27.26 at expiry for her to break even. For Rick, the break-even price is higher at $28.38. if you're buying puts, the reverse is the case. I like to focus on, I'm more of a bullish trader, so I focus on buying calls. So now this gives you an idea uh, what your payoff looks like depending on the strike price that you go for. If you're risk averse like Rick, you'll choose a more out of the money call for a higher payout, but with the risk of losing all your investment if the price were to go um, go against your projection. But Carla is conservative. So if you're a more conservative trader, you look for an in the money or at the money um, call. In this case, now keep in mind this at the time, GE stock price was $27.20. So if you pick a lower stock price at $26, you would if you chose a contract at $27 and at $27, you'll ought to be negative at 11.5%. If you went for a call, let's see. So if you went for if just like call it, if the stock drifts down to $26 at option expiry, you'll be negative $55.8%. So for her to break even, the stock price needed to move up to $28 for her to be profitable. And for Rick to be profitable, the price needed to be at $29. Okay. So whenever you're picking strike prices for option calls, there are two factors to keep in mind. Are you risk averse or are you conservative? And what kind of payoff do you expect at the end? This goes into your plan. It's always good to have a plan of action before you start trading. And if I were to play this particular option like Rick would, and I'm willing to put up a little money, and I'm willing to lose all that money, I would buy an out of the money call and expect for it to hit my strike price and go above it before I become profitable. Otherwise, if it goes the opposite direction, I'm going to lose all my money. Let me share this chart, and we're going to look at something different. We're going to look at a different ticker. I'm going to look at a different ticker here. I'm looking at an Amazon ticker here. And yeah, let me pull up Dash. I like DoorDash. They've been doing very well lately, especially in this COVID era where people are home, or a lot of people are working remotely. Companies like DoorDash, which is a logistics company for food delivery, they've been doing very well lately. You can see on a monthly chart here. The stock price is currently trading at $183, which is rated a strong buy. I don't have a lot of data on this monthly, so I'm gonna pull up a daily chart. you can see my support and resistance lines. So since earnings call around 13th of May this year, we've seen a strong trend in the up direction. Yeah, I'm gonna turn off some of these indicators. I like this chart pattern right here. It's a bullish chart pattern. I think it's actually called a scallop. A scallop originates from a downturn, price rally, and a return back to price rally, breaking through a resistance of $165.64, and a return back to that former resistance, which is now support, and a bounce off in the upward direction. So we can see that this chart still has a lot of runway to go. The next resistance here is $203.84, and we're currently trading at 185. This is a strong resistance here because you can see it's made several attempts here, here, and here to break past it or to move past it. So if I'm bullish on this, on DoorDash, first let me introduce some more. I'm going to introduce some more signals, some more indicators, so we can establish some type of confluence. Confluence is when you have multiple indicators pointing in the direction of your price prediction. Sometimes TradingView can be like a pain because certain things that you're trying to do doesn't get done, especially when I'm sharing it. I'm trying to minimize this particular pane, but I don't see the button to do so. So it usually hangs around here, but I can't find it. Okay, so, well, as you can see, let me just do it manually then. Get rid of some of these short trade. Okay. All right, so you want confluence. Confluence, like I said, is when you have multiple signals pointing in the same direction, confirming your price prediction. My CCA squeeze here, which is an indicator, is showing a green right here, which is indicating that it's moving in the upward direction. CC swing is also green, which is bullish. I have a buy signal here on my cheat code algo. Okay. And like I said earlier, I have my support and resistance that I've drawn here. And so if I'm going to take out a call on this particular trade, let me go to my thinkorswim and look at what kind of call spread that we have, or call what kind of options we have for the month. Before we do that, first you want to determine what is the measured move for this particular chart. The measured move for this particular chart will be the distance between this point, which is the lowest point of this particular move, of where the downward movement ended before the uptrend. I'm gonna use my ruler tool to measure from this point up to the resistance. And I have $49. And so with that, I'm going to use the same ruler to find my expected move from this resistance point, and I'm gonna add $49 to it. So this chart, ideally, I expect it to move, the price action to move to $235. But it's going to take a while to get to $235 from the current price of $183. Keeping in mind that but before we do anything, we want to know how much does Dash move per day. That's when you need another indicator called the ATR, or the average true range. Now, from my ATR, I can tell that Dash moves $8.61 per day. How did I find that out? I place my cursor at the last candle and line it up with the ATR indicator. And you can see that right there, it's pointing at $8.61. So if this chart moves, if this price moves $8.61 per day, and I want to calculate how many days it's going to take this price to get to $235. I'm going to divide $235 by $8.35. There's my calculator. Okay, so pulling out my calculator here, $235 divided by $8.35. That's about $28. Or 28 days. 28 days is more than a month. So I'm going to take a month call on this chart. Okay. So that means that I'm expecting for this price action to take a month to get to $235. Now, price action does not move in a straight line up. It's going to make multiple reversals and accumulation. You know, price action goes, let's see here, what do you call this? Markdown, accumulation, markup, distribution, markdown, mark. So we're currently in the markup phase, and it's gonna hang out here. If this is the day chart, so I'm assuming it's currently distributing. And the next phase will be markup, because that's what I'm expecting this chart to do. I'm expecting it to rally again. So I'm gonna take out a call. So again, the next resistance here is $203. And that's the next resistance up. I'm expecting it to take about, wait a minute, I need to reduce this. Say, how long is it going to take to get to $203 or 18? It's $18.53. And how long is it going to take to get to $18.53? That's about 2 weeks, if we did the math. Because that's $203 divided by 18. So I'm getting 11.2. So if you round that up to 14 days or 14 trading days, that's about 2 weeks. So I'm going to take a 2-week call. So let's look at what kind of options we have for Dash. Okay, let's see. These are the options that exist for Dash. option chain. 2 weeks from today, today's the 26th, so we're gonna take a weekly call. So 2 weeks from now, will put us at August 13th, right? And we're looking at this option chain here, and I'm expecting the price to hit, these are the strike prices. Okay, remember what we talked about in the money and out of the money options? You also want to pay attention to open interest. Open interest are the people who are interested in buying this particular option. The more people who are interested in buying this option, the easier for you to sell it. And also pay attention to volume. All right. So we're looking at a price move to, what was that? 203? $203. Now we can go with 200, 202.5, 205. Now 202.5, there's for this particular call, has an open interest of 346. It's really high. You can see right here that there's a lot of people who agree with my sentiments just from the chart. There's 346 open interest compared to the other options on this chain. So I'm gonna choose this one, this particular one here, the 202.5 call. The spread is not too bad, $4.30 to $4.65. So keeping in mind of in the money and out of the money, the closer to this price that you purchase, our current struck price is $183.66. So if you want to pay $4.30, you click over here. If you want to pay $4.65, you click on this end of it. All right. I'm gonna remove this one. So I'm getting ready to buy 100 call. Um, That was for an August 13th contract. I'll close this out and pick a different one. So you can see, because I already own some of these shares, I already own Dash sell shares, it's offering for me to sell covered calls. Um, Here we go. So I'm about to place an order to buy 10 August 13 calls at 202.5, $202.50 strike price. I'm gonna review and place the trade. I bought a weekly call of 13. So let's look at my position here. This is really interesting. I'm learning this live. So there's a lot to learn. It's interesting once you get a hang of it. Okay. So that's how you trade these charts. You first want to spend a lot of time understanding the chart, the ticker, what moves it, um, draw your support and resistance lines, identify chart patterns, look for confluence with other indicators. And once you're able to identify confluence, usually I'm looking for 4 or more indicators to line up with my price projection, and then I'll take the trade. You can see I'm using 2 different platforms. Think of TradingView to draw my charts, and I use Thinkorswim to place the trades. So, all right, go ahead and practice these, how to pick the right strike price, and I wish you all good luck with it. See you next time.